Hi friends, so today we are going to talk on a topic called as what is financial planning. Many of you would have come across this term called as financial planning. So what is this financial planning all about and what are few ground rules and the process of financial planning is what we are going to cover in today's video. Now, financial planning is nothing but a process by which we can meet our financial goals. Everybody will have multiple goals. There are long term goals as well as short term goals. Most of us will have a goal of creating a retirement corpus. So, this could be one of a long term financial goal. Some of us, if you are married and have a kid, you may want to create a corpus for your kids' marriage or kids' education. So there are long-term financial goals as well as short-term financial goals. Somebody would want to have money ready for some travel requirements or an emergency corpus. There could be anything. Different people will have different financial goals. A systematic approach of meeting these financial goals is what financial planning is all about. Financial planning is going to ensure that you are systematically meeting all your financial goals. Now, there are certain myths among people that I don't need financial planning, and they give multiple reasons for that. See, one thing which is very clear is everybody needs financial planning because if you plan properly, it will be easier for you to meet your various financial goals, and also you can plan your inflow and outflow accordingly. So, people say I invest regularly in fixed deposits, so I don't need any financial planning. Saving money and investing in fixed deposit is perfectly fine. That's a good strategy. But still, you need to do goal-based investing. So there should be a goal, and in order to meet that goal, you should do your investments. Some people say that I don't need any financial planning because I don't have any long-term goals, which is maybe good at this point of time. But you will keep having some loans. It could be a short-term financial goals, and as you start earning, getting married, getting additional responsibilities, you will bring in all these goals will be there. So whether you invest in fixed deposits, whether you have long-term goals or you don't have long-term loans goals, some people will say I don't have any loans as of now, so I don't want to do any financial planning. Or some people will say I have already taken some life insurance and the same is going to take care of my financial goals. All these are fine, but that's not goal-based investing. Investing in FD or investing in life insurance product is not goal-based investing. You need a goal-based investing to be done. You need to invest for your retirement corpus. So how much you should invest every month to ensure that you get a steady amount for your retirement. Similar thing needs to be done for your child marriage, child education, travel requirements, emergency corpus. So based on every goal, there is a need for investments to be done. Now, a few ground rules when you want to do your investing or financial planning, because a lot of people keep asking us, so we thought we'll give you these ground rules which can be easier for you to follow, and that can help you in doing your financial planning. The first doubt will people have is, should I invest in equity instruments? When I say equity, it could be a direct equity or it could be through mutual funds. The common rule is your investment in equity products should be equal to 100 minus the age of the individual. As you grow older, your risk taking ability will come down. So at young age, you can take a lot of risk, and the investment in equity should ideally be 100 minus the age of the individual. So if you are a 20-year person or a 25-year person, 75 to 80% of your investment should be on the equity products, balance should be on the debt products. Debt, you have fixed deposits, you have employee provident fund, you have PPF. So multiple options are there for debt investments. Emergency funds is very, very critical. This is something which you should never miss out. 2 years back when COVID came in, people would have realized the importance of emergency funds. So emergency funds is something which is very critical. Ideal rule is the emergency fund should at least be equal to 6 to 12 months of your recurring expenses. So whatever recurring expenses you have, in that make it 6 to 12 months. That should be the emergency funds. This should ideally be in the form of fixed deposit. basically something which can be taken out whenever you need. FD can be broken at any point of time. A debt instrument, basically emergency fund should be in a debt instrument. Some of you could even keep it in your savings account as well. If you are planning to take any loans, be it housing loans, car loans, personal loan, ensure that your monthly EMI is not exceeding 30% of income. People in practical world exceed beyond this limit also, but then it will become a little difficult. So you should ensure that your EMI is not exceeding 30% of income. If you are planning to buy a house, which I think we had even covered a video on whether to buy a house or go for rental mode. If you decide after that you want to buy a house, ensure that the price of the house is not exceeding 5 times of the annual income which you earn. So if your annual income is 10 lakh rupees, you can buy a house worth 50 lakh. If it's a 20 lakh, then you can buy a house worth 1 crore. See, the bank may give a higher loan also, but ensure that your whatever house you are buying, if the price does not exceed 5 times. 5 times is a rule. Even if it goes to 5.5, something around that is fine. But making it 10 times of annual income or 12 times of annual income will make it a little difficult. There's also a rule called as 50-30-20 rule. This is something which you should do when you are planning your monthly outflow, or how are you meeting your expenses. 50% should be spent on essential items. Essential is your food, clothing, or it could be on rent. 30% can be spent on non-essentials. If you have some travel requirements, anything is there, you can spend. 20% should ideally be saved or invested. At a young age, it is better to reduce this 30% on non-essentials and do more of saving and investing. So this is a simple rule, but we have our clients who invest even 40% of the money or 50% of their monthly income. So they try to invest at a young age so that it is easier for them to achieve all their financial goals. Now, what is the process of financial planning? This is where we can also play a part, because we have done financial planning for a lot of our clients. They do come back to us saying that these are their requirements. So we understand the requirements and then give them what can be done. Before you start the process of financial planning, the first thing which is needed is I need to know what are my financial goals, be it both long-term as well as the short-term financial goals. Both of them should be in place. It is okay to have a broad idea of your financial goal. It's not that, for example, one of the financial goal, some of our clients told us that they have a goal for child marriage. That is, the kid, once it becomes 25 or 22, whatever be the age, at that age they want the marriage to be done. Now for that they wanted to plan the expenses. Now I'm not very sure how much money would be needed, but a broad idea. Then we include some inflationary aspect and then decide that this much funds would be needed. The child education, there could be multiple goals which can be there. So once you know your financial goals, the next part is knowing what are your monthly inflow and outflow. Monthly inflow and outflow. Your monthly inflow can be from salaries, can be some investment income. What is investment income? Is you may earn some interest income, some dividend income. You may be doing a business and some allied incomes can be there. Understand all your monthly inflow. You can bifurcate them into how much minimum you will get and some additional can be there. For example, for a salaried person, there is a minimum inflow and sometimes bonus will be there. Business income, it is slightly difficult to forecast the inflow. So at least minimum I'll get this much. Beyond this, there can be something extra. Then understand your various expenses. You may want to classify them as recurring, non-recurring, essential, non-essential, something which can be deferred, which cannot be deferred, and there will be a balance money which is available. So whatever balance money is there, we ideally tell clients to create an investment in. If you do a mutual fund, we say SIP investment in the mutual fund. You can even do a systematic investment in a fixed deposit also, or it's technically like a recurring deposit. So you can do your SIP investment in mutual fund or in your debt instrument, PF, PPF. Some of our clients do some investments in the name of their child also. So whatever they want to do, you decide the quantum and then keep doing the investment. The most important part of financial planning is please take care of the insurance requirement. This is something which many of us miss out, but this is the most important part, because insurance will be very critical, be it health insurance or your life insurance, because whatever planning you do, that will become whatever you are saying that every month this much inflow will be there, this much outflow will be there, and you are planning to save something. But suddenly, if some medical issues are there and you need to spend huge on health requirements because healthcare expenses are going up, it's necessary that there is a medical insurance and also a life insurance. When I say life insurance, a term insurance. What is a term insurance? Is basically it's an insurance where you pay. For example, there are plans, a 1 crore term insurance can come at a premium of some 15 to 20,000 per year. So you pay this premium. If anything happens to the person, the nominee gets that amount, the dependents get that sum insured. If nothing happens, this amount doesn't come back to you. So it's like your normal vehicle insurance and other things. So it's critical that you take care of the insurance needs. Any of you, if you have any requirement for financial planning or if you have any doubts, do message us or comment on our video. Thank you, friends.